Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is your money, your wealth.
You just inherited $1 million. How would you invest it? Would you buy stocks? Would you buy bonds? Would you buy gold, real estate? How would you invest that $1 million? Or if you have a 401k, IRA, 403b, whatever, the investments that you currently have, how are you currently investing them? Markets at our all-time highs, interest rates all-time lows. What do? Stick around. We're going to weed through the mess and tell you how you should properly invest. Welcome to another episode of Your Money, Your Wealth. My name is Joe Anderson. I'm a certified financial planner and president of Pure Financial Advisors, one of the largest fee-only financial planning firms here in Southern California. As always, I'm with my partner, Big Al Clopine. He's the CPA. He's the man, the brains behind the scenes. So let's dive in. Let's get on what's on my mind today. Big questions right now. Markets all-time highs. How do I invest my money? What I want to give you today is a gift from us, Pure Financial Advisors. It's think, act, and invest like Warren Buffett. If you're not going to take our advice, at least take advice from probably the smartest investor of our time. Think, act, and invest like Warren Buffett. You can go to yourmoneyyourwealth.com, click on the icon, and get your free book. It'll take you an hour to read, and once you get done with this book, you will be a better investor. Or if you stick around for the next half hour, you will be a better investor. Like I said, don't take my word for it. This is a clip from Warren Buffett. Let's go to that to see what he says.
The biggest mistake they make is listening to a lot of other people and buying something because they think it's going to go up next week or next month, and for whatever reason people give you.
So here's a problem, right? Look at Warren Buffett. Everyone's looking at the next hot stock. What's the best investment that I can get into? Should I buy this individual company? Because I have a certain belief that I believe it's going to go up. That's the problem with most people in their investment strategies. They think that they might know more than the overall markets. Do not invest that way. And Al, that's probably one of the biggest problems that we see. So let's go to Big Al. So when you're looking at investing, it's like, okay, Al, what should I get into? What's the best stock? What's the best sector? That's probably one of the worst decisions that people can make when they're managing their own money.
Well, it is, Joe, and that's why we're going to spend some time on this show talking about how to invest correctly, how really everybody should invest. And well, there's going to be really 5 main topics that we're going to cover today. And I'm going to start with number 1, which is globally diversification. Diversifying globally, which means you want to have assets around the world, not just in the United States. And you don't want 1 or 2 or 3 or 4 companies. You want many companies, perhaps in an index fund, exchange traded fund, inexpensive type funds that hold thousands of stocks, so you're diversified globally. The next thing you want to consider is you don't just want one asset class like the S&P 500. You want several asset classes. We'll get into what that means, but to have a well-diversified portfolio, you want to have many different investments. You will need to tax manage, and that simply means pay attention to the taxes inside your investments. Some investments are more tax efficient. Some types of accounts have different tax treatments because it's not really what you make, it's what you keep. Make sure that you rebalance your portfolios periodically to make sure that you have the right assets for you. And then finally, given a choice, pick low-cost investments rather than expensive ones. Did you know certain investments are less expensive than others? And Joe, these 5 things, I mean, in some ways it sounds kind of basic, but this is what you need to follow to be able to successfully invest over your lifetime.
Well, investing should be basic. It should be easy.
Right.
But Wall Street wants to make you believe that you have to have a crystal ball to figure out exactly what you need to do to make some money. The markets themselves create a ton of wealth. But you want to make sure that you keep your investment strategy very simple, that you understand the strategy. And there's some mistakes that a lot of you are making, such as you're not investing globally. When we look at portfolios, most of people's portfolios are heavily weighted in U.S. domestic growth stocks. If you look at the market capitalization across the world, right, the U.S. right, is only a small component. You're missing 60% of the game if you look at market capitalization, because if you're not investing globally, or if you're not investing internationally, you're making a big mistake. You're leaving chips on the table, so to speak.
Yeah, and the other thing too is if you just kind of fast forward to 2050, the estimate is about 17% of global capitalization is really going to be in the U.S. and the rest is internationally. So you have to realize that it's not just the United States only. You want to have exposure to all markets. And why? It's because different markets go up and down at different times. They're not exactly correlated, which means that when you have certain asset classes domestically, those similar type of asset classes globally may be going in different directions, and you want that because it reduces the risk in your portfolio.
Well, yeah, here's the problem, right? If I have all my money sitting in large company growth stocks here domestically, if the market tanks, all of your portfolio is going to blow up. So you want to make sure that you have negatively correlated asset classes. In most cases, if you take a look, when international companies do well, domestic companies do poorly, and vice versa. So that's going to help you on the downside. If you have everything bet on one asset class, such as domestic stocks, that when the S&P per se drops 10, 20, 30%, what's going to happen to your overall portfolio? So you want to make sure that you have the diversification necessary. And the first step of this is to say, all right, well, do I have any of my portfolio divested or invested internationally? So that's one of the key components of building the overall portfolio.
Well, it is, and I think the next thing is really how should you invest? I mean, there are stocks, there are bonds, there's mutual funds, there's real estate, there's natural resources like gold, silver, and oil and gas, that sort of thing. You want to have components of each of these, and sometimes people load up all in stocks and then they want to get out of the market because they feel like it's too risky, and then they get just into bonds. You want to have a mixture of each of those. You want to have components of each, both domestically and internationally.
Right. So if you, real simply, here's what you need to do. Is so when you're looking at investing your money, you want your money to grow. And so there's two things that you can do. You can purchase an asset or you can lend your money out. If I'm purchasing an asset, that could be a fractional ownership of an organization such as common stock. I could buy an organization. I could be the CEO of my own company. I could also look at buying real estate. I could buy precious metals, easy for me to say, or natural resources. So that's me purchasing an asset. So then I'm having my capital purchasing an asset, hopefully that organization does well, and then I reap their profits. Another way I can do it is I can lend my money out. All organizations want to grow. They do it in two ways. They give you a piece of their company, or they're going to take a loan. So you're going to act as the lender. Here, XYZ Corporation, here's $100,000. They're going to take that capital and they're going to try to utilize that the best they can to help their company's profits grow. What you're going to receive in return as an investor is an interest rate, such as 2%, 3%, 5%, whatever the note is. So it's just like a loan, or if you're buying a CD, you're giving your money to the bank in exchange of a certain interest rate. They're utilizing that capital for their purposes. Then at the end of the term of the loan, you get your money back. So if it's 1 year, 3 year, 5 years, or 30 years, depending on the type of bond that you purchase, that's what's going to determine your interest rate. If you think about it, if you give an organization your money for 30 years, there's a lot of risk associated with that, so you should demand a higher interest rate. If you're looking at, hey, if I'm only going to give it to them for 5 years, well, there's less risk associated with that, so you'll receive a lower interest rate. So how you build your wealth and how you build your portfolio is that you buy an asset or you lend your money out. It's as simple as that. When we get back from the break, we're going to dive in a little bit more and get more complex to say, all right, well, if I'm investing my money in organizations, what type should I buy? Smaller companies, large companies, value growth. There's a smorgasbord of information out there, and there's a lot of things that you want to make sure that you utilize to increase your overall expected return, because when markets correct, you don't want to be on the bottom side of that. Stick around. Don't go anywhere. You're watching Your Money, Your Wealth.